Hello, hi. So now we are going to start with derivatives and it's going to be a very interesting topic. Stay tuned. Hi, good morning. How are you? All
I'm
good?
good.
Thank you.
Good, yeah.
Yes. So today we are going to start with derivatives. And in derivatives, as such, there are only two readings, that is markets and instruments. And then we go about pricing and valuation. Yes, price and valuation are two different things. We'll talk about that. But the thing is that I've actually created a new reading in derivatives. This is contrary to what the institute has done. And that reading has been not an extra reading, but a combination of the two readings that you see here. And why so, I'll probably explain you when we go through derivatives, right? So technically speaking, we have just two readings, that is derivatives market and instruments, and the basics of derivatives pricing and valuation. These are the two readings that we are going to deal with. But as I said, I have just added one more reading, which is a combination of both of this. And why so? Because derivatives as such includes different types of instruments like forwards, futures, swaps, and options. Correct? I'm sure you must have heard about this, right?
Yes.
Out of this, options are very much different from forward, futures, and swaps. So everything about forward, futures, and swaps, I've kept it separate. And for options, I've created an altogether a new reading, which is a combination of 48 and 49, which you see here. That is whatever the reading name is, number is. But that's an extra reading, which will cover the two readings, all parts about options. So I'm not going to follow here the institute flow, because as a student, when I see, it's good from the curriculum point of view that you cover everything, but not from the flow point of view, because being worked with the industry into different products, I think you need to understand them product wise, not syllabus wise. So I've carved out that options completely different, and I'll discuss about that option later on, because everything else is quite connected and option is completely different. That's why. Clear? So even after finishing these two readings, we'll be doing the same thing about these two readings, but for options. Is that clear? Okay, so let's start with derivatives. And the first and foremost thing that we are going to deal with the first reading is what exactly derivative is. Where does the name itself come from? Derivative. It's not completely related to the mathematics derivatives that many of us are worried about. That is it the derivative and integration that we did in mathematics? Or well, not. It is very much logical and one of the most creative or innovative aspects in the world of finance. I'll talk about derivatives, how it created the history of it in the future when we probably proceed. But as I said, it's one of the most creative instrument ever created in finance, right? Now, the name derivative itself has a meaning of it. Derivative means a value which is derived from something. Value which is derived from something, right? So technically speaking, it's a financial instrument. Of course, we are dealing with financial instrument. Am I correct? That derives its value from something, and that something is the performance of the underlying asset. The underlying asset. Now, let's take up an example, okay? For example, a wooden chair is made up of wood, right? So if the prices of woods change, will the price of wooden chair remain the same?
No, it will change.
It will change, right? So can I say the price of wooden chair is derived from an underlying asset which is called wood? Correct. So here, that wooden chair is a derivative instrument. Why? Because its value is derived from the value of the wood.
Wood.
Am I clear? So, what is the derivative here and what is the underlying here? In the example that I gave? Yes.
Derivative is chair
right?
and the underlying asset is wood.
The underlying asset is wood. Perfect. Now, here the underlying assets can be the price of stock, bond, commodity like gold, copper, crude, or it can be weather. I'll explain you how people play derivatives on weather or livestock. Anything which is traded, can have a derivative instrument. So the prices of, let's say, stock in the spot market. Now, you know that there is a spot market and there is a futures market, which is what we call as a derivatives market, right?
Yes.
So futures market is the value of the asset in the future, let's say after 1 month, 2 month, or 3 month, correct? So between the price of buying the asset now and between the price of buying the asset after 3 months, there is a gap of 3 months, right? So the future prices of the stock are dependent on the current price of the stock and various other factors. But if the current prices of the stocks will change, then the future price of the stock will also change. Am I correct? So technically speaking, the spot market is the underlying asset, and the futures or forward or options, they are called derivative markets. Why? Because the prices there are derived from the
Spot market.
So now take up an example and connect the example which I said, that the wooden chair is the derivatives market, future options and forwards, right? And the wood itself is the underlying instrument, which is the spot market, where where these derivatives can be traded on any type of asset. That underlying asset can be a stock, bond, currency, commodity, or anything. Clear? So it can be a stock, bond, commodity, currency, whether livestock, or anything that is traded in the future is called a derivatives market. So the underlying is called as the cash or the spot market. Clear? And the price of the underlying in that market is called the spot price. Clear? So the value of the futures is dependent on the is derived from the spot price.
Spot.
Now, where do this trading actually occur? Derivatives have a separate platform where they are traded. So spot market is a completely different platform and derivatives is a separate platform. Now, not necessarily every derivative is traded on the exchange. Like you have National Stock Exchange, you have NASDAQ, you have NYSE. These are exchanges. So not every derivative instrument is traded on the exchange, but there are huge derivative contracts which are traded out of the exchange, which is what we call as OTC, over the counter. Is that clear? For example, real estate. Do you buy and sell real estate on some exchange?
No.
Do you buy gold when you want to wear it or make a jewelry from the exchange?
No.
No, you go to the local gold shopkeeper where you buy the gold. You go to an agent or directly to the developer to buy the property, or to the seller who wants to sell it. You don't go to an exchange. It's a one-on-one transaction. That's called OTC. Is that clear? Right? What do you think is a bigger market, exchange or OTC?
OTC.
OTC, of course. Not everyone goes to the exchange, right? So clearly, what is derivative? Derivative is the value of asset in future, forward, or option, which is dependent on the spot price or current prices of that asset. So derivative is a value of an asset whose value is derived from another asset, which is called the underlying asset. Is that clear? Right.
Yes.
Now, it's not the end of the discussion of derivatives. We are going to discuss at length. So stay on with me and try to understand step by step. Ironically, what happens with me is that when I start derivatives, most of the candidates have actually learned about derivatives in bits and parts. It's a very scattered thing that they've learned with. And because of that, what happens, that I always say half information is more dangerous than no information. So because of that, people have some theories which they find it very difficult to understand, because they feel that, no, I never required this. And also some of the shocks that they get, no, it doesn't happen this way, it happens in market this way, right? So I'll discuss all about that, but in a process. So when I was also learning derivatives, I became very impatient that no, I know this. But no, the thing is that try to understand it step by step. I've created in a flow that you'll really like it, and you can really use it. So many things will come across the way which you will probably feel that, no, I knew this thing, right? But focus on what probably you didn't knew, or what is an addition, or what is a correction. Clear? So now let's understand the use of derivatives. Where exactly is derivative used? First of all, derivative is not just a verbal contract, but it's a legal contract which is enforceable by law on both the parties who deal in them, right? So normally when I say both the parties, one party buys an asset, another party sells an asset, right? So derivatives act more like an insurance contract, right? What happens in insurance? You recollect from the risk management. In insurance, I shift or transfer the risk. Am I correct?
Yes. Yes.
I transfer the risk on someone else. So in derivatives, we are going to use derivatives for one exclusive word that is called hedging. Hedging is protection. And protection means transferring of risk from one party to another. Especially people use options for hedging where they pay premium. And that premium is nothing but like an insurance, correct? You seek protection from insurance by paying premium, right? So here there are two types of participants. The one who buys the asset, or the one who buys the contract rather. Instead of asset, I'll say the one who buys the contract is called as a long party. And the one who sells the contract is called as a short, or the writer. Is that clear? So now instead of using buy and sell, we will use the positions called long and short. Am I clear with that? Right? It means the same, but the reason that long and short were used to connect it with the derivatives market. Clear? Now compared with the spot market, derivatives trade at lower transaction cost but uses leverage. So why is the transaction cost low? Because of the volume. In derivatives, you trade at huge volume. It's not that you can buy one share. You have to buy contract, which is what we call as a lot size. So you can't buy one piece of gold or 1 ounce of gold. No, you may probably have to buy 100 ounces of gold. You can't buy 1 liter of a petrol. You may have to buy contracts of 100 barrels of crude. So basically, this does not come in single unit. It comes in a quantum of unit, and that's why, because of the scale or the volume, the cost per unit, the transaction cost per unit is relatively low in derivatives. Is that clear? Right?
Yes.
But in derivatives, you don't have to pay for the entire value of the contract. You just have to pay a part of that money. And that's why we say derivatives is like buying a house, where you don't have to pay the entire amount. The part of that is funded by the bank. Here, the broker funds your derivative contract, and that's why we say we use margins, if you recollect that. And those margins are nothing but their leverages. Clear?
Yes.
What comes with leverage? High returns, but also high risk. So compared to the spot market, two unique things about derivative: that the transaction cost is low, but there is a leverage. Is that clear?
Yes.
Now, this derivatives was actually made for, I'll explain you when we go to forward. It was actually made for people to hedge their positions, especially in the agricultural sector. Like farmers were, the ones who were basically, the derivatives was derived for them, I should rather say. But eventually, apart from hedging, the farmers used derivatives to protect their prices. But apart from hedging, derivatives eventually moved to speculation, trading, arbitrage. We will discuss what exactly is arbitrage. And so various activities were associated with derivatives, not only protection of the position, not only hedging, but along with that, other things like arbitrage, speculation, and trading also came with derivatives. This is where derivatives, I believe, went out of hand. And when speculators enter into the derivative market, it becomes very much volatile. Clear, right?
Yes.
Now tell me, which is the world's largest economy by the size of
US.
US? Do you have an approximate idea of what the US GDP would be approximately? Let's say US GDP is around 20 plus trillion dollars, around 22 or 23 trillion dollars. Correct?
Mhm.
The second in line comes China, which is
China.
coming close around 18 to 20 trillion dollars. And then comes the Eurozone markets and Japan and France and Germany, and comes India and all. Correct? Now, so no market in the world as of now is more than $25 trillion, right? And if you combine all the financial markets in the world, even that would be somewhere around, let's say, 100 or 200 trillion dollars. 200, that's already the highest I can say. 200 or 300 trillion dollars at max. Correct? That's a global size. That's a global GDP, I can say. But let me tell you, derivatives is much bigger than this. I've pulled out this data from Bank for International Settlement. It's a global, union of all the banks, you can say. And since, derivative contracts cannot be exactly measured. Why? Because many of them are OTC. Correct? But what you probably can look is at this graph on the right is the notional amount outstanding, the total amount of contracts which are due or outstanding. And you will see all these figures are in not billions, but they're in
Trillions.
dollars. And as of 2021 and so on, the derivative contract size is almost higher than $600 trillion. In the past, it has also reached to, before the subprime crisis, I can say it also reached to around $800 trillion. $800 trillion. Can you believe that? That's the size of derivatives market. And this includes forward, futures, options, swaps, commodities, equities, for any assets which you know. Clear?
Yes. It is a chart of like all the only for derivatives, right?
Yeah, only derivatives.
So
Nothing.
okay, so related to equity, commodity, and all derivatives.
Most of the derivative instrument that you see here. See, in the next slide, I will discuss the different types of derivative instruments and different types of markets. There are two things. But you recollect the underlying asset which I showed you?
Yes.
The underlying asset on which the derivatives is traded. That underlying asset, see the names here. It can be stock, bond,
Stocks, bonds, commodity.
whether livestock and all, right? Here, I am taking the major derivative contracts, that is equities, commodities, credit means bonds, you can say, interest rate derivatives, which is also related to interest rate instruments like bonds and all, foreign exchange, that is currency, and other derivatives, which I said is weather and livestock, and many other derivatives is traded on so many different products.
In that graph, the IRD is
interest rate derivatives.
Interest rate derivatives. They are
swaps, which is in the next slide. I'm actually going to come, but still,
okay.
It is. Let me just come here. Okay, so it is basically swaps and forward rate agreements on interest rates. Those are the two things that will be focused here in level 1. In level 2, you will be also doing interest rate options. So try to understand two things. One is a type of contract, okay? And within that contract, what assets are traded? I repeat, one is called the type of contract, right? The type of contract can be forward, futures, options, or swaps. Okay. And within those contracts, see, contracts are, you can say, different markets. Within that market or contract, what are the securities traded? They can be stock, bond, currencies, commodities, or interest rate instruments. Are you getting my point?
Yes.
Right? So there are two different things which people actually mix up. So the class of the derivative or the type of contracts, basically, if you see, there are two types of contract: forward commitments and contingent claims. Now, within the forward commitments, we have forwards, futures, and swaps. And in the contingent commitments, you have options. Are you now understanding why did I create two separate topics?
Yes.
One for the existing ones, forward, future, and swap. And for options, I created completely different. Because in options, I'm not going in detail right now. We'll do when we do options. But just to give you an idea, in options, there is one party which has the right and the other which has an obligation to transact. Compared to that, in forward, futures, and swaps, the parties are committed to honor the contract. They have to do the contract whether they want or they don't want after that. But in options, you have a choice. So the way option functions is completely different. Clear?
Yes.
So these are the categories of derivatives market. Now you can say that you have a market in Vancouver, you have a market in Toronto, you have a market in Calgary. So these are different markets, right? Now within those markets, you may find fruits. You will find an apple here, you'll find an apple there, you'll find an apple there, right? So those instruments which you find in the market are stock, bond, commodities, currencies, etc., etc. Correct? So always differentiate between two things: derivatives market and spot market. In the derivatives, you have different types of categories, which forward, futures, swaps, and options. Clear?
Yes.
But what are the securities traded in that? Those securities can be stock, bond, currencies, commodities, interest rate instruments, and etc. Clear?
Yes.
Now, let me tell you again one more thing. For me to make it simpler for you, all these derivative instruments that you see, or derivatives markets that you feel here, you see here, forward, futures, options, and swaps, they are traded on a platform which can be a exchange
OTC.
or OTC, correct?
OTC.
Exchange or OTC. Now, which one is traded on exchange and which one on OTC? I'll come to that point. Hold on to that point. But what are the features of being traded on exchange and OTC? What are the features of being traded on an exchange or an OTC? First of all, in exchange, who decides how the contracts will be? Who decides how the contracts will be? Do you decide or does the exchange decide?
Exchange.
The exchange decides. So exchanges generally decide, and they have the standardized contracts. Standardized contracts. What do I mean by standardized contracts? That the contract size, the contract's duration, the contract prices, of course, the prices will be derived by demand supply, but the size and the maturity of the contract are decided by the exchange. For example, the exchange will tell us that for every dollar, the contract is of 1 million and the maturities can be 1 month, 2 month, 3 month. That's it. So if I want to trade, I have to trade in the multiples of 1 million. I can't have 1.25 million. Clear?
Yes.
Are you getting my point? So that's the situation in exchange. I can't have a contract of 2.5 months. I'll have to have either 2 or 3. But OTC is more like a customized contract. In OTC, the two parties can mutually agree on what amount and size of contract they want to deal with. Clear? Now, generally, I tell people that how to relate exchange traded and OTC. Tell me one thing, that let's say you are joining a new office and you have to, get a new suit or a blazer, okay, an office attire which you are required to. what are the two choices that you can probably get this suit from? It's a very natural. I'm not.
Oh, okay. Okay, names. Yeah, okay. Van Heusen,
Van Heusen or Zara, something like that.
Zara, yes.
Let's say I'm a fan of Zara. So let's say I go to Zara. Okay, I want to make my suit, right? I go to Zara and check out the ready-made suits there. Okay. Or I go to my local tailor or designer to have a better word. Local designer. Okay. Who has been doing my clothes for last, let's say 10 20 years. Correct?
Yes.
Is there a difference between both?
Yes.
In Zara, I will get my size exactly.
No.
No, but at the local shop, I can customize, isn't it?
Yes.
Correct. But let me add one more condition in the Zara that I will just put out. Let's say it's a factory outlet of Zara. What happens in a factory outlet? What happens in a factory outlet? Can you buy one piece? Can you buy one piece?
No.
No, you have to at times buy in quantum, right?
Yes.
Right. So now think of this, that if you go to the factory outlet, you will have the standard sizes 35, 36, 38, 40, 42, 44, and etc., right? And you will have to buy the fixed number of quantities. Clear? But if I go to the local designer, I can stitch the clothes exactly suiting to my sizes. Correct? And I can buy one or two pieces also. Is that clear? Right?
Yes.
Now tell me a situation that if I take let's say a shirt of 40 size from Zara, and they tell me that Kunal, you have to buy 10 quantities at least. So I buy 10 quantities and I go, and they are all packed. And then I come back to Zara and say, no, the 40 doesn't suit me. Can you give me 42? Will Zara be able to do that? Will it find easier to replace or difficult? Tell me.
It might be.
No, see, everything. Hold on. Everything, don't tell me depends and might be and all. Think of from that point, right? A customer, you work in a shop also, right?
You get it. You will get it.
You get it. Why? Because you think from that point that if you give me back 40 sizes, I can easily sell it to someone, right?
Yes.
Now that of course depends or etc on the company policies and all, but we are just taking an hypothetical example.
Yeah. So you can definitely return and get size 40.
Replace, correct?
Yes.
But now imagine this, that you have been to your local designer and you stitch two clothes as per exactly your sizes and fittings. And now you go back and tell, oh, I don't want this. Can you replace and give me another? Is it going to be easier for him or her?
No.
Why? Because they'll find it difficult to find exactly someone fitting your size. Are you getting my point?
Yes.
So, which contracts are easily, executable? The
Exchanged
or customized? Standardized. So there is high liquidity with respect to standard contracts and very low liquidity with respect to customized contracts, that is OTC. Clear?
Yes.
And you can check out the prices online of what you want and all, right? So there is high transparency here and there is low transparency in the customized contracts. In OTC, contracts are between two people and you don't know what's the real price and all. They don't reveal that. But what you see on exchange is highly transferable. Right? It's very transparent. Sorry.
Yes.
Clear? Who decides what happens on the exchange? The exchange. An exchange is controlled or regulated by the Securities Exchange Commission. So exchanges are highly regulated, I can say. But OTC contracts are not illegal, but they are less regulated. Why? Because it's between two people, and then you have to probably, if there is some issue, you'll have to probably file a court case or something, etc. You don't have a third party to, do the arbitration in that process. Clear? So where is the default risk more? On exchange
Over
or
the counter.
on over the counter. So default risk is very low on exchange and very high on OTC. Clear? Right?
Clear.
Now, generally students ask me question that, sir, out of the forward future swaps and options, which are on OTC and which are on exchange? Now, there's no clear-cut answer to this, but few things are very sure. For example, swaps and forwards are definitely on
OTC.
OTC for any instrument, right? And futures and options are on exchange. Clear? Futures and options are on exchange. Right? That is a generic perception, and which is to a larger extent correct also. For example, whenever I want to deal in futures and options, especially for stocks or commodities, I'll go to a recognized exchange. Clear? But when I want to do a customized forward or a swap contract, I cannot find that on exchange. I'll have to do one-on-one. So anything which is customized is basically forwards and swap. They are very much customized contracts. We'll see what exactly they are, but they're customized contracts, and therefore you'll find them on OTC. But futures and options are very standard contracts. Therefore, you'll find them on exchange. Clear?
Yes.
Right. The important thing about those contracts which are on exchange is that the middleman there, that is the exchange itself. And because of exchange, there are two things which get simplified. First is the clearing. Clearing means the verification part. Who verifies the trade records? Well, the exchange does that. So when I put a buy order and when someone puts a sell order, between me and that seller, the exchange is the one who verifies that order through the process which is we call as clearing and settlement. Clearing is the process of verification, and settling is the process of transferring or exchanging money from one point to another point. Clear?
Yes.
So clearing and settlement, which the exchange provides me, where clearing means verification of the trade and settlement means exchange of money or transfer of money from one party to another party. Clear? That risk or headache is taken care by exchange. I don't have to worry about that. Correct? But OTC is very informal network. It's a market of informal network where there are dealers or brokers between buyers and sellers. There's no specific location. For example, you want to buy currencies, you can go to a bank, or you can also go to a local currency, authorized dealers, correct? Like Western Union and all. You want to buy gold, you can go to the gold market, or souk is what we call in the Arab world. You can go to the local shop, or you can go wherever you want, right? So there's no specific one location like an exchange where you get all the shares. That's what is with OTC. Clear? It's a largely unregulated market, and the contracts do have counterparty risk. What do I mean by counterparty risk? That there is a high chance that the counterparty, the party on the other side, may default. Is that clear? Because here the verification or the guarantee is not taken by the exchange. Here, in many cases like currencies, banks act as dealers or brokers between you and the seller, right? Because they hold the membership of International Swaps and Dealers Association, the Derivatives Association. So this is just for your reference, but it's not that OTC is not legal. It is very much legal, but here, it's a one-on-one contract, you can say, and very much customizable, but also has its own risk. So it has its advantage that you can make the contract as per your need, but it also has that default risk, on your head. Clear? Right?
Yes.
Everything cleared about what is an exchange traded contract, what is an OTC, what is forward commitment, and what is contingent claim. In the forward commitment, you have forwards, futures, and swaps. In the contingent one, you have options. You have pros and cons of both the exchange contracts as well as the OTC. Both have their own advantages and disadvantages. For example, when you ever want to buy a currency, you don't go to the exchange, you don't go to the NYSE or something like that. You go to the bank to exchange the currencies, right? So because banks will give you what you want exactly. For example, if I want to have $17,252 to be exchanged, bank will give me that, correct? But that contract is very much difficult to find on an exchange where you have standard contracts. Clear?
That
But
is what that is what you mean, that bank is a dealer, right?
in
In
that
the
case, bank is a dealer. In
Okay.
other case, someone else can be the middleman. As I said, in real estate, the broker is between me and the buyer and the seller. So they're virtually, they are not the dealers, they are just the brokers. So any liability is on my head if I do something wrong, right? On the exchange, there is never a default because the exchange ensures that the buyers and sellers pay their required dues. Clear?
Yes.
So therefore, there are rarely defaults on exchange. On exchange, you'll never find a default even after huge volume being there, because they ensure that with margins, which we will discuss today and which we have already discussed in equities, but here also we'll discuss that. Clear?
Yes.
So we will start with one by one all the derivative contracts, and we will first begin with the forward commitments. Within the forward commitments, you have three parts: forwards, futures, and swaps. Clear? So let's start with forward commitments. First of all, in the forward commitments, you have forward, but just generally, why is it called forward commitments? Because here's an obligation for the buyer and seller to honor the contract which they have come into, right? So forwards are contracts where both the parties have an obligation. Both parties, when I say both the parties, means very important. Both the parties means
buyer and seller.
Buyer and seller both. Now, this is the biggest difference between forward and contingent. In contingent, we will see later on, not now. Both don't have the obligation. Only one has the obligation. That's the biggest difference. In forward commitments, whether forward, future, or swaps, both the parties have obligation to engage in a transaction at a later point. That is, honor the commitment as per the terms agreed at the initiation. So as per the contract that you and I decide, right? And in that contract, what is decided? Decided is that you and I will trade at a particular price in the future. I will buy from you and you will sell me, let's say, a stock after 3 months at a fixed price, which you and I agreed today. That price is called as a forward price, or the price at initiation. Clear?
Yes.
That price is fixed at the initiation, which is to be honored when the contracts are settled. Settled means when we actually exchange the cash flows, correct? That's probably in the maturity. See, in forward, you are not going to buy or sell anything now. I generally tell people that you just book the contract now. Clear? You just
book the contract.
Book the contract. It's like, now I'll come to the forwards. This is generally about the forward commitments, all, okay, whether for future, forwards, or swaps. But now we are going to deal with forwards, specifically forwards. And forwards are in OTC. Futures also work like forwards, but they are on exchange. Clear? So there's a minor difference between forward and future. Forward, the rules are set by you and me. Futures, the rules are set by exchange. But the functioning is almost same. The structure may be minor difference because of exchange decided structure and customized structure. Otherwise, the function is almost same. So we'll go to the futures in the later part. But forward is what I generally tell people is like booking a movie ticket after 1 month. Let's say there's a blockbuster movie coming after a month, and these days you don't go and watch the movies because of the crisis that we are into. But let's assume that we are in the happy times and you have a blockbuster movie coming out after a month, and you feel that the tickets of that movie, or let's say tickets of that football match, are very difficult to get. But today, somehow they are opening up the counter for that ticket. What would you do? You right now book those tickets.
Book those tickets.
Clear? Assume that you don't pay full amount. Assume that you don't pay the full amount. You just book your tickets. Let's say these days we book by blocking, they block some amount on a credit card, right? Even that happens these days. They don't debit the money from your account, but they freeze that much amount in your credit card. Have you heard about that? No?
Yes.
Okay. So what did actually happen? Did I buy the contracts to see the show now or see the show, let's say after a month?
After a month.
After a month. So if I want to see now, the prices may be different, but if I want to see after a month, the prices are very much different, right? So I just booked the contract now. Assume that you did not pay anything. Assume that you did not pay anything. So you just booked it, right? On maturity, that is after 1 month, what will exactly happen? You will settle the contract. How? You will pay the money to the counter and the counter will give you the ticket. So the execution happens today or on maturity?
And on maturity.
On maturity. That is the settlement. Clear?
Yes.
So forwards are OTC contracts. They don't need any specific platform. In a forward contract, one party agrees to buy the underlying asset from another party at some point of time in the future at a fixed price. So let's say I'm going to buy from you that ticket after 1 month at a price of, let's say, $100 now. We decide $100 now, but I don't pay you $100 now. Why? I will pay you $100 on maturity and get the ticket. Clear?
Yes.
These contracts are customizable, right? But therefore they are also illiquid. Clear? Which we discussed there. It's very
Yes.
difficult to reverse such contracts. Each party is subject to the possibility that the other party will default, right? So there is a chance that I may not give you $100 and there's also a chance that you may not give me the tickets. Clear? But we are talking about not a soccer match ticket, but we are talking about financial contracts and how the financial contracts work. For that, before I discuss the last point and the settlement, I will have to give you up an example. Okay, let's say I will use now the exact terms. Okay, let's say the spot price of the asset is 1,000. Spot price of the asset S0, spot price today is 1,000. It means that if you want to buy today, how much will you have to pay?
1,000.
1,000. And the forward price after, let's say, 3 months, the forward price after 3 months is 1,100. Okay. You probably want to buy the asset in the future. So what will you do? You will today book the asset, book the contract. Am I clear? You wanted to what? Buy or sell? Come on. What did I say? You wanted to buy the asset in the future, right? What do you mean by buy the asset in the future? It means you want to take which position?
Long.
Long position. Clear? Those who take long position now, those who are booking the contract now, why are you booking the tickets now? What are you worried?
For the price. Price change.
Will it go up or down?
Up.
Up. Therefore, you expect the prices to rise. That's called a bullish position or bullish expectation. Bullish. Clear?
Yes.
Bullish means you expect the prices will rise.
Go up.
Therefore, you do the long now. You go into the contract long now. This is all what is today. Now, on maturity, there can be two scenarios. Let's take two scenarios. Either the price can go up or down. Correct? Let's say the prices go up 1,200 or if it goes down to 1,000. Clear? This, if it goes to 1,200, are you happy or sad?
Happy.
Why? Because you feel relief that thank God I booked the contract at 1,100 with Kunal. Now I will just have to pay him 1,100. I don't have to pay 1,200. What is this 1,200, by the way? This 1,200 is the price of the asset on maturity. That is what we call as Spot on maturity, that is T. T can be 3 months, after 3 months. Are you getting it?
Yes.
This is called ST. ST is, what is ST?
Spot at maturity.
Spot at maturity. So now clearly, what is S0? Spot today.
Today.
And F0 is the price of the 3-month forward contract today. On maturity, you compare that with the spot in the market, that is ST. Either it can go up or down. Well, if it goes up, you're very much happy. So what will you do on maturity? You will pay me 1100 and get the asset. Is that clear? This is called delivery of the contract. I physically give you the asset. Clear? This is called delivery of the contract. What happens in delivery? How much will you pay me?
1100.
1100, and I will give you asset.
Asset.
Irrespective of the asset goes to 1200 or 1000, we are committed. I'm going to give you asset, you're going to give me 1100. Clear? But if the asset prices goes 1200, you are happier because you can sell this asset at 1200 in the market and get a gain of 100. But if the asset's value is only 1000, and if you sell that after buying it from me, it will make a loss of 1000, loss of 100. Sorry. Clear? Now, what is that I discussed? This is called delivery of the contract. Why delivery? Because you wanted the asset. So you paid me how much?
1100.
And in return, I gave you the asset. This is called delivery. But then there is another method of settlement where you don't buy asset from me. I don't sell you the asset. We just exchange the difference in amount. So you don't pay me 1100. I don't give you the asset. Instead of that, we just see what is the current price in the market on the maturity, that is ST, and decide who gets how much. So if the price is 1200, I means the short will pay to you the long. How much? $100.
100.
And the contract is done. No exchange of asset. If it goes 1000, you pay me 100 and the contract is done. Clear?
Yes. No transfer of assets.
This is called netting off. This is called netting off. We just exchange the net difference.
Okay.
Here, are we settling with the delivery?
No.
No. Therefore, these are also called as non-deliverable forwards. In non-deliverable forwards, we do the netting off and only the cash is exchanged between you and me. I mean, the amount is exchanged between you and me, not the entire 1100. Clear?
Yes.
So, net, if it's deliverable, if it's a deliverable contract, do you have to do something? Yes, you have to pay me 1100. And do I have to do something? Yes, I have to give you the asset, isn't it?
Yes.
So when the contracts are deliverable, you also have some obligation, I also have some obligation. Either of us can default. Clear? But when the contracts are cash settled or netting off is there, does both parties have to do something or only one of them will have to do something?
One.
Only one. Clear? Now, this is what is called settlement. On maturity, the settlement of the contract can be either by delivery or by cash. Clear?
Yes.
Now, delivery means physically exchanging the asset by paying the entire amount. Clear? But when the settlement occurs without the delivery, they are called as non-deliverable forwards. Now you get why? Right? Or they are called as cash settled forwards or contract for differences, different names. But what is this process called as netting off? What is netting off? Where you don't do any settlement by delivery of asset, but just see the difference, and that is cash settled. Clear? This is what you will do probably when you are speculating, isn't it? When you don't want the asset. Are you getting my point?
Yes.
But if you actually want the asset for your needs, like you actually wanted gold, then you would say that, no, I don't need the difference. Get me the gold. I need gold. But if I'm trading in a crude contract and I don't need crude, I just want to bet on the crude, then I may just go for the cash settlement. Now, who decides this? Well, if you are an exchange, the exchange decides what happens. The exchange is already notified that whether this will be cash settled or there will be delivery. But if it's a customized contract, you and the counterparty both can decide how you all want to frame it. Clear? So now go to this point of forward. After netting out, does both party have the risk or only one party has the risk?
Only one.
After netting out, only one party can possibly default at any given of time, because either you have to pay me or I have to pay you. That's what happens in the forward contract. Clear? Does this example make it clear everything?
Oh, yes.
Right. There are three things that you should notice here, apart from the settlement process, which is delivery or cash settle. Is S0 is the spot price today. Then F0 is the forward or the future price for 3-month contract. I've put that in the bracket 3. And ST is the spot on maturity with which you are going to compare your forward price.
Forward
Okay.
price.
And that's what will tell you who gets to pay or receive how much. Clear? Forward perfectly?
Yes.
Now the futures also work in the same manner, only there is going to be minor change. I will show you how. Ready for it?
Yes.
Now, futures are standardized contract. We know that, correct? Nothing new in that. Futures contract have specified underlying asset, also fixed time to expiration, and delivery at settlement conditions and quantity. So everything is decided by the exchange. Being traded on exchange, the future contracts have high degree of liquidity, regulation, transparency, and protection against the default by the counterparty. We discussed that, correct? All these features. Here, the buyer of the contract is called long futures. Long means I commit to purchase or buy the asset in the future from the seller or the short at later date and at a fixed price, which you and I agree today. That's called futures price. Now, instead of forward price, I will say that as
Future price.
Future price. This is the price which you and I have agreed upon at the initiation of the contract itself. So before the contract started, you and I have agreed that what will be the price. Clear? When a future contract is initiated, no money exchanges. So today when you and I enter into the contract, do we pay anything? No. Correct? But on maturity or before that, whenever the contract is settled, either of the party will have an inflow and the other party will have an outflow, right?
Yes.
Because the future contracts are generally cash settled. Are you getting my point? Future contracts are generally
Cash settled.
Cash settled. Is that clear? Right? So initially there is no obligation on both of us, neither you or nor me. We don't have an obligation, but on maturity, the payoff can turn in either of the way, either the long makes money or the short. That's where the obligation arises. Clear? But tell me one thing, very important thing. Today you and I agree to enter into the contract. In order to when the future, let's say the contract is of 1 month maturity. So within the 1 month, will the prices remain the same?
No.
If the underlying prices change, then the derivatives or futures prices will also change, right?
Yes.
So every day when the prices change, either the long or the short is liable to pay money. Clear?
Yes.
Now, because of this, the exchange who has the responsibility here will collect margin from the long as well as from the short, so that neither of us will default. Clear?
Yes.
So futures are, contract is for 1 month, right? But every day the calculation takes place. What calculation? As to, I say, who is the winner and who is the loser. Even though we don't finish the game, we may take the game till the last day, that is maturity, which is 1 month. Correct? But every day the exchange does the calculation that as of date, who has to pay how much. And that amount is compared with the margin that I've collected from you. Clear? This process is called futures settlement, which happens on a daily basis. Are you getting my point? So the futures contract are settled on a daily basis. By settled, do I mean that the contract is finished every day? No. We do the calculation of it on a daily basis to find out what? To find out who gets paid or who has to pay. Clear?
It is unrealized.
Absolutely. We've done that in equities.
Yeah. Okay.
So it's an unrealized gain or loss. But that's what I'm saying. We have to do it on a daily basis. I am going to do sums based on this. You will find the sums based on this also. Don't worry about that. We will do sums. But before that, try to understand that this calculation which happens on daily basis is called as mark to market. It is called M2M, mark to market. Clear?
Yes.
This daily settlement process is undertaken at the settlement price which the exchange will decide. And the contracts are marked daily. Why this happens daily? To check whether your account is running low of the balance, your account has enough money to afford the losses or not. Clear? So this amount of your gains or losses are compared with the money that you have deposited, which is what we call as margin amount. So the accounts are maintained by investors for the purpose which is called as margin account. Participants can offset their position. Offset means if you have a long position, how do you exit the position? By being short. So when you have long and short, your net position becomes zero. So if you have bought 100 contracts, and now if you sell 100 contracts, you are virtually out of the contract. And the difference is what you have to either pay or receive. Clear? So participants can offset their position by taking a opposite position. Clear? So if you are long a contract, how will you exit from the contract? You don't automatically exit from it. You will have to short a contract of the same size in the same contract, right? Then you are out of it. Clear? So overall, can I say in the futures, the last date to execute or to offset is, or to square off is? The last date? The maturity, the maturity date, right? So by the maturity date, by default, everyone will have to square off their contract. So can I say the total number of long will be equal to total number of short? Eventually, there will be no stocks at the end. Clear? It will all disappear. It will all become zero. Correct? So at any given time, the total number of contracts outstanding on the exchange is called open interest. I'll show you what open interest is. But the contracts which are open, yet to be settled, are called open interest. But by maturity, everything will become zero. Everything will become zero. So today you take a long contract. How long can you hold it? How much you can hold it till the maturity? So till the time you don't close that contract, it's called open interest. Are you getting my point? Yeah. Till the time you don't close the contract, it's called open interest. Once you close that contract, then the open interest will come down. So when the open interest is increasing, what does it tell you? That new and new positions are being built. Clear? When the open interest is increasing, it means new positions are being built up. But it also means that by maturity, they will all be squared off. Clear? Yes. Now, there's a huge discussion on open interest, which I'm not getting into. It's something that we do in technical analysis also. Unfortunately, in level 1, we don't have too much of discussion over it. But this superb thing to discuss about open interest, maybe we can do it after the sessions, or you can ask me in person about that. But that open interest is a very, very important technical indicator. Apart from the volume, it tells you that what market is pursuing. So tell me one thing. Why is the difference between the future and the spot price? Why is the difference between future and spot price? Tell me that. What is the biggest reason that we...
Interest rates.
Basically, it is because of the time value of money, isn't it? Because of the time value of money. What's the difference between present value and future value? We've done that in QM.
Yes.
What is the difference between present value and future value? It is only and only because of the time value of money, isn't it? So let's assume today the spot price is, let's say, 1,000. And the future price will be, how much is the time in the contract?
3 years.
You can say 3 months. Okay. So if let's say if I put the rate of interest as 12% yearly, assume there is nothing paid by the stock, no dividend, nothing. What should be the future price? You can take spot plus add 3-month interest. So just add 3%, 3 months, just simplify. I'm just simplifying the calculation. So for 3 months, the interest will be 3%, right?
3%, yes.
So what should be the future price? Just add 1,000 plus 3%. That is 1030.
130, yes.
This should be the minimum price of the contract. Clear? We will discuss about the exact way of pricing in the next reading, not now, but I'm just trying to explain you something. So go with me in this example. It's not an exact way of pricing, okay? Somewhat similar to this. Clear? Right? So hold on with me here to understand something. Not exact pricing. Exact pricing is almost this, but minor difference, which we will see in the next topic. Now tell me that 1 month is gone. After 1 month, will the spot price remain the same?
No.
No. And can you enter into the contract of 3 months after 1 month? Can you enter into this contract after 1 month? The 3-month future contract? Yes, you can enter at any time and you can exit at any time. That's what the beauty of future contracts are. Clear?
Yes.
So after 1 month, let's say anything. Let's say the price of the asset is 1080. But will the future price be same? The future price was 1030 because it had how much life remaining? 3 month life remaining. Now the future price will have at least 2 month difference between the spot and futures. So will the price be same?
No.
No. What will be the price? Let's say that day spot plus at least 2 months interest. Correct? Yes or no?
Yes.
Now, even if I don't change the spot price, let's say if I keep the spot price same, still the spot and the future price will be different, right? Correct?
Yes.
How much will be the difference between spot and future of 2 months? Clear? So can I say the future price will be at least 1020 because of 2 month interest?
Yes.
Now suppose 1 more month is gone and the spot is still the same. Hypothetically, it's not never going to remain the same, but just I'm taking it a simple example for your calculation. So let's say even the spot price is still the same. Will the future price be the same as spot? No, because there is still 1 month remaining. So at least it will be 1010, right? Now just imagine a day before the maturity. 1 day before the maturity. On that day, the spot and future price, will it be same? Will it be same? Yes or no? 1 day before maturity.
Yes.
No. How can you say yes? At least there will be 1 day of time value of money, isn't it?
Yes. Yeah.
Money for 1 day? Yes, it
1
will.
day. Yes.
So if you take for 1 day also, there will be some difference between spot and futures, correct?
Yes.
Now, with the same logic, tell me what happens on maturity. On maturity, will there be any difference between spot and futures? No, because there is no time value of money in the equation left. There is no time left. Are you getting my point?
Yes.
What is the maturity terminology that we say for spot? You recollect that? We say ST, spot on maturity. Is that clear?
Yes.
And spot on maturity and future on that day, which is, I will say FT, just for your simplicity. They both should always and always and always be same, irrespective of anything. And this will happen only on maturity, that is the expiration date. This is the reason why, if you recollect something, that there is the maximum movement in the stock price on the maturity, that is on expiration. No trader goes for a holiday on expiration. That's the time when both have to converge. What both have to converge? The spot and the futures. They both have to converge, irrespective of whatever the price is. Getting this point? Clear? This is a very, very, very unique feature of futures. What is that? The future market follows the principle that future prices converge to the spot on the expiration. Clear? So the future prices will be exactly to the spot price on maturity on the last day. If not, then there are people waiting to hunt that. Who are those people called as? They are called as arbitrageurs. Clear? Because it should match. How can an asset have different prices when there is no time value of money left? It should have the same price. So what I would like to say here is that I would like to add here that on maturity, ST equals to FT. Is that clear?
Yes.
Now I've put a snapshot about how a future contract looks like. You can probably connect to the link and see. So if you look out here, this contract is for 29 July 21. This is where the contract is going to end. Clear? Right? Now, what you have to look is the spot price. Right? And the current price of the contract is 15,880. So 15,880 and 860, there is only a minor difference of 20, right? Why? Because there's only 1 month left in the contract. Clear? Now there are various things here. What is that you have to see is the lot size. How much is the lot size? 75, because it's on an exchange, right? In futures, the standard size. So you have to buy not one Nifty. How many Nifty index you have to buy? 75. And the open interest percentage change is positive, means 4% more contracts are open. Clear? How many total contracts are open as of now? 9 million. 9.7. Clear? Now, these are the basic features that you should see. There are various other indicators. I don't want you to go into that right now, but this is the basic. So what is this? I can say this is F. This is S0. Clear? This is the future price for a contract after 1 month. So this is, I can say, if anyone who wants to enter today will have to pay F0 for 1 month. They will have to book at this price, 15,880. Clear? But on maturity, they both should become same. Is that clear? About how the future markets prices and everything is displayed. Now, if you want to go in the next month contract, you just have to click the next month, and the later on month, second month contract, and the third month contract, you can do that. Okay. Clear?
Yes. So we don't have any. We don't have any discussion for open, like in the book. In level 1, we don't have anything about.
So you have those. See, there are several indicators. not one that you should look into the stock price. Those all indicators are part of your technical analysis. In technical analysis, you see open interest also as one of the indicators. One, not many. Not the only one. There are many indicators. One of the indicators is open interest. Clear? So when I will look at the stock prices to trade, whether in spot or in futures, I will look at several technical indicators. Clear?
Yes.
So I've just displayed this so that you can get probably more understanding. Many of these points are actually not even mentioned in the books that you will refer. So yeah, clear about the future settlement. Settlement clearing is very important. Now we are going to do some calculations based on this settlement. So don't worry about that. But you're clear, right? Long, short,
yes,
netting off. Clear? Forwards can be, you and I will decide. So in forward contracts, what will happen? It can be cash settled or delivery, right?
Yes.
For example, if India is going to buy 100 or 1,000 barrels of crude oil from UAE, they will book a forward contract with the UAE. But will they actually buy crude? Yes, India will buy crude because it needs crude. So they will go for cash settlement or delivery? Delivery. But if I book a contract, do I need delivery? I don't want that much of crude, right? So I will just speculate on it because I think the crude prices will go up. So I will go for cash settlement. Clear, right? Now, so this is what all about future contract settlement is. Clear? Now, how the margins exactly work, that's what we need to understand. And first of all, before I proceed ahead, let me ask you, why do we collect margin? We've discussed that. Why do we collect margin? Why do we collect margin? Why does the exchange collect margin?
To
come on. Yes, to ensure that neither the long or the short defaults. Simple. Why? Because the long can also make losses, the short can also make losses. You don't know where the prices are going, right? So exchange, who has the job of clearing and settlement through the clearing and settlement agencies, they provide the guarantee that there will be no defaults, right? And to ensure this, they will have sufficient margins in their hand, right? So when I want to get into the futures contract, I have to pay margin to the exchange. Clear?
Yes.
Right? So to ensure a smooth mark-to-market, exchange requires various margins. Exchange requires various margins to be deposited by the participants in the trade. Participant means the long and short both will deposit. Clear? Now, what are these types of margin? First, the initial margin, and then the maintenance margin. Initial margin is the initial amount or some percentage of the contract value which you have to put with the exchange. Let's say your contract value is $100,000. Exchange will demand 10% of it. So you have to give $10,000 to the exchange as margin. You have to keep with them. Clear? But exchange will also put up a condition that at no point this margin value should go below a minimum point. That minimum level is called maintenance. So let's say if 10% or $10,000 is my initial margin, then 5% may be my maintenance margin. So exchange will tell me at no point, Kunal, your value or your balance in the account should go below 5% or 5,000. Clear? Right? But what if it goes below? If it goes below, then
margin call.
Exchange will give me a margin call and ask me to deposit that difference, which is called variation margin. Clear? So variation margin comes when I get a margin call from the exchange, and this happens when the maintenance margin condition is not met, when my balance goes below the maintenance margin. Clear? In that case, I will have to deposit the money not till the initial or not till the maintenance margin, but till the initial margin. What do I mean by that? Let me check out that. So here the initial margin is
40%.
40%. The maintenance margin is 20%. Investor has bought the futures contract. Bought means
Long.
Position is long. Correct. You make gains when the prices go up. You make losses when the prices go down. Clear? So I am long futures contract. Clear? When the price of the stock was $100, assume the contract size is 10. So the minimum lot size is 10. Clear? I have given you hypothetical prices here. First of all, what is the contract value? 100 into 10, that is 1000. Initially, there is no mark to market outcome, but the balance, you have to pay how much? The initial margin? 40%. So 40% of 1000 will be 400.
400.
Clear? Now, what happened the next day? I've given you a scenario where the next day the prices went down 90. So your contract value is now 900. What is the situation? There is a loss of 100. Am I clear? See the loss from the previous value. This is called mark to market. What will be my balance? 300. Correct? What is the minimum balance that I have to maintain? 20% initial margin. So I have to ensure that at no point my balance goes below 200.
200.
So 1000 is the contract size, the contract value, initial contract value into 20%. My value should not go below 200. Clear? So it's 300. Will I get a margin call? No. Now when the prices go to 78 further, my value is 780. So from 900 to 780. Why 900? Because from 1000 to 900 is settled. Daily settlement. Now from 900 to 780, how much is the loss? 120. And the balance will become 180. Will I get a margin call? Yes.
Yes.
Because it is going below 200.
200.
Now, how much do I have to deposit? I have to deposit till the initial margin, which is 400. So I have to deposit not 20, but 220.
20.
So that it becomes 400. Clear?
Yes.
Now see, then the prices went up to 92. So now the value is 920. So my value will be 780 and that is settled. So 400 was the balance. Now there is a gain of how much? Tell me how much is the gain?
140.
140 is the gain, right? So my balance will be now 540. Clear? There's no margin call. 540 will be the balance. Clear? So now if you check out the situation, how much is your opening balance? The amount that you deposited?
400.
400. Clear? What is the total mark to market loss? Check out this. 220 minus and 140 plus, which is 220 minus 140. 60 and 80. Negative 80, right? So your mark to market loss is 80. And how much did you put in the call? 220.
220.
So that is your closing balance. Are you getting it? 540. Yes. And if you want to directly calculate your M2M loss, where did your price start from?
100.
And it ended to?
92.
So the difference in the price is 100 minus 92 into the contract size of 10. That is your M2M loss. Clear? Make sense?
Yes.
Right? Now, this is how the margins are calculated. On a daily basis, they are settled. And when the balance goes below the maintenance margin, you get a margin call. The margin call has to be filled till the initial amount.
Initial amount.
Clear? Initial margin. Now, you did the same in equities also, right? Equities margin and now futures margin. Why are we doing it again? Is there any difference, by the way? Well, there is a difference. What is that difference? In equity, who has to pay to whom? When you deal in equities in spot market, who has to pay to whom eventually?
Buyer.
Yeah, the buyer has to pay to the seller.
Seller.
Clear? So the buyer uses margin because the buyer cannot put in all his or her own fund. So the buyer takes margin from the broker and with the buyer will pay to the broker with interest, right? And the buyer has to what? The buyer has to perhaps, yes, pay to the seller. So the buyer is the one who has to give the margins, because the buyer has the chances of being running away in the spot market. Clear? Yes. But in the derivatives, in futures, neither the buyer, nor the long or the short, neither the long or the short are going to eventually take the asset. They're just going to cash settle. So both of them can have losses. Are you getting my point? Clear? Yes. So compared to equity margin, see, equity margin, traders use credit amount required beyond the initial margin to purchase, okay, stock borrowed from the broker with the interest payable. So compared to that, in the futures, both parties to the futures deposit initial margin. Both means the long and the short. Are you getting my point? I'll repeat, in equities, only the buyer pays the margin. But in futures, the long and the short both pay margin. Is that clear? Yes. Right? So they both have to deposit some initial margin with their respective brokers. But since purchase of actual underlying is not done, they do not need to borrow. So they don't have to borrow because they don't have to pay the entire contract value. Clear? You don't have to pay the entire $1,000 year ever. You just have to pay the difference. Clear? So here, my borrowing is not going to be for entire $1,000. Correct? In equities, when you buy a $1,000 stock, you are borrowing for $1,000 apart from your money which you are going to put. But in futures, are we actually going to take the entire contract and sign the check? No, we are just going to do the cash settle, which is going to be just the difference. Correct? Yes. For example, if you see the previous example here, in the forwards also, did we actually do the exchange of 1,000 or 1,100? No, it's just the difference that we exchange, right? Clear? Right? The 100 is the difference that we exchange. Right? So with respect to that, what happens in the futures contract is also that year, both the parties need to put some deposit with the exchange, but they don't have to do the borrowing. Why? Because the entire amount is never going to be exchanged. It's the difference that is always going to be exchanged. That's not the case with equities. So that's a minor difference here. Clear? Right? Rest, if the margin is 10%, the leverage is 10 times, which is what we've done in equity, right? That is not an issue here. Now, one more thing is important is the future price limits. Do you remember that there are circuit breakers or there are limitations of the price? It cannot go beyond a point on a daily basis. It cannot go below a point on a daily basis. Those are the limit up and limit down, right? So because of high leverage by traders use high leverage in derivatives, right? Some future contracts contain a provision of limiting the possible price. Why? Otherwise, the prices can shoot up like anything. So if I've collected 10% margin from you, and if the prices on a daily basis go 40-50%, then there is a high chance of default, isn't it? Clear? So therefore, futures will have margin limits or price limits, right? These are intended to assist clearing houses in managing credit exposure. I'll repeat. What happens if there is no margin? If there is no price limit? The losses can go beyond the balance given suddenly, and then there will be default. So therefore, to control that, the futures do have the future price limits. There are 3 types of price limits basically. Actually, there are only 2 types and a band is there. So we will discuss that. And they are all based on the previous day, the yesterday's price. Okay. So first you have limit up. Limit up is the highest price beyond which the stock cannot go on one single trading day. Are you getting my point? Clear? So for example, let's say currently the price is $100. Okay. Now 10% is the limit up. So on a daily basis, it cannot go ever above 110, right? That's called limit up.
Limit up.
And it cannot go below 90 also. That's called limit down, the lowest price. Clear? And therefore it forms a band that on a daily basis, the price will be between 110, the up limit, and the lower limit, that is 90. At any time in the day, if the stock hits the price, either the up limit or the down limit, it becomes a lock limit. Lock limit means the trading stops for that particular stock for either the entire day or for some time limitation set by the exchange. Clear? So what is a lock limit? It is a situation where
the price hits the limits,
either the up limit or the down limit.
Or the down limit.
Clear? Okay. So this is all about the futures. Now we will move to the swaps. Any doubts or anything about futures till this point?
Nothing for now.
Okay.